Holy smokes, are we back? And is it time to buy the dip? In this video, we're gonna go through exactly whether or not we are back and whether or not it is time to buy the dip. Spoiler alert, every single dip this year has been a buy the dip opportunity. I kid you not. Liberation over here. And I remember, you see this double dip right here at the end of April? I made videos going, folks, set trailing stops. Don't be dumping right now because we might be about to rocket ship up, and trailing stops would be the perfect way because you'll never get stopped out if you're on this kind of run. And the people at the time are like, Kevin, you're just making videos to try to hedge your bets and cover both sides. Like, no, here's the evidence as to why we're saying this, okay? That was then. You can watch the videos, they're there. But take a look at this. Every single dip has been bought so far. So the dip we had at the end of July, super minor. The dip we had in September, super minor. The October dip, super minor. This November dip has been a little bit more frustrating because it's been about 3 weeks. You know, we're about 3 weeks of like down. Right before Halloween, we hit all-time highs right before Halloween, and then it's been down, 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 down. Why has it been down? It's been fear because of the AI bubble. It's been fear because of private credit and liquidity stress. And these are all reasonable fears. In fact, I have to say the thing that makes me the most nervous right now is what I'm seeing with AI spending in the bond market. In fact, take a look at this chart right here. This chart is disgusting. So this is a pretty busy chart because I wrote all over it. I apologize. Just ignore the text for a moment. Look at the little red lines. So the red lines show you bond issuance, okay? So on the left side over here, I have 20. So $20 billion of bond issuance. And you can see it's kind of rare, you know, after 2020 that you see these lines, but they pop up. This arrow right here shows you the ChatGPT moment. And you basically had no debt financing for over a year after that ChatGPT moment. And then in 2024, like the second half of 2024, you started seeing, you know, a couple $20 billion deals, 20 billion, maybe a $12 billion deal, a little bit at the beginning of 2025, right? But now what are we seeing over here? Every month, boom, boom, boom. And you total it up, it's actually $88 billion of debt financing on the right side. So it's no surprise that you're seeing credit default swaps get more expensive for Meta and Oracle because people are like, man, dude, we're all of a sudden taking on a whole lot more debt than we used to. Because any single one of these lines on the right is more debt financing for AI than we've had at any of these other lines on the left. Maybe with the exception of just that one right there. But basically, you've got 3 of these sandwiched in a row on the right side, and it's really indicative of, whoa, why all of a sudden are we taking on so much debt? So I wrote a few notes here. I wrote, right now, we're at the phase of the economy where as long as debt issuance continues, we can keep this growth going. And that's good and it's bad. It's good because it means for right now, it doesn't necessarily mean we have to roll over. It just means like, hey, like, that's a whole lot of debt. I mean, I think Bucko over here, literally Bucko Capital Bloke, writes, David's saying the quiet part out loud. This administration has made some catastrophically bad economic decisions, and he's right. They backed themselves into a corner and cannot afford to go backwards on AI. This is in response to a David Sachs tweet, which says, according to today's Wall Street Journal, AI-related investment accounts for half of GDP growth. A reversal would risk recession. We cannot afford to go backwards. Full article. In other words, if we stop seeing this AI spending, we could end up seeing a recession right here. A reversal could risk a recession. Okay, great. But if we're relying on AI for not going into a recession, then what we're really saying is we're relying on debt. Because in the last 3 months, all of this AI boom has been funded by debt. And that's really scary because Ray Dalio put it really well. He did this like 10-minute segment with CNBC. I'm gonna save you the time, okay? Basically, the last like 30 seconds are all that matters. And he's like, well, you know, yeah, we're definitely in a bubble, but you know what it takes to make a bubble pop? You gotta prick it. And you know what pricks the bubble pop? People dashing for cash. I can't do a Ray Dalio accent, but basically when people need cash, That's when the bubble pops. Okay, well, when is that? Nobody knows. But what we know is what I wrote on this chart, which is that debt issuance is going extreme right now. That's not necessarily to say it's going to stop, but we're starting to see that nervousness, right? We're seeing that nervousness with Blue Owl. Blue Owl's like freaking out. Look at what's happening with the private credit companies. Blue Owl backed the $30 billion Meta deal, which I thought was brilliant. Like, if you want exposure to the AI, boom, with getting a good valuation, in my opinion, Meta's at a good valuation, and you don't want as much of the debt risk, Meta's really interesting because they just financed a $30 billion deal where they have the opportunity to cancel their leases every 4 years and pay like a nominal early termination fee. Guess who holds the bag? Blue Owl. Guess out of these private credit funds, which is performing the worst? Blue Owl. It's down like almost half. Its stock has almost halved in value. The only thing that's doing slightly worse than Blue Owl in the private credit space right now is, Grindr. Grindr, I guess Grindr's not really in the private credit space, but what I should say is what is doing worse than Blue Owl is Grindr. Grindr has probably the smallest PP right now.
Little PP.
And that's because their executives are literally getting margin called because they leveraged up their own personal shares. And so their personal shares are getting revoked, they're getting seized, and they're getting liquidated. So who knows, maybe there's an opportunity to buy the shrink on Grindr, but that's probably a topic for a different video, maybe even a different channel. That's like only Meet Kevin or something. But anyway, I mean, private credit's obviously an issue, right? We see the Tricolor collapses right here. We actually topped after the Tricolor collapse. First Brands collapses here. The Crypto 1010 liquidation is here. And then, of course, we have multiple other liquidations following that. Now, of course, the CEOs and the executives at these companies, they don't want you to think that there are any kind of issues or cockroaches. In fact, you literally have the Blue Owl CEO saying, quote, "The point being, like, somehow, by just talking about this enough, people have worked themselves into this imaginary world where there's some bigger potential credit problem." That's what the CEO is saying. And then, of course, you have a list of all these companies like collapsing in private credit. And I kind of think it's disingenuous because it's every single time people go, guys, everything is fine. You should know that everything is not fine. It's almost every single time. Like, go into, on this list, you have the Sonder Hotel bankruptcy, right? Well, here is the Sonder Hotel bankruptcy piece in the Wall Street Journal, front page of the Wall Street Journal today. And in it, they literally do, where was it? It was an all hands meeting. Anyway, they talk about doing this all hands on deck meeting. Here it is. Employees were summoned to an all hands meeting. Managers expressed optimism that Sonder would soon be on solid ground. In other words, guys, everything is fine. Literally, look at this. There's nothing to worry about, says Nick, Sonder Regional Vice President, said during the meeting. We just have to let everybody know that there are some problems, but don't worry, everything is fine. What happens 9 days later? They go bankrupt. Every single time. It's like, you got a company going, guys, don't withdraw your money. Everything's okay. Bankrupt within a couple weeks after that. It's like the kiss of death. It's almost like saying everything is fine is the kiss of death itself. I don't know. That could be like causation without correlation. But anyway, the point is, everything is not fine. Like, there actually are private credit issues. And yes, our GDP without artificial intelligence would probably be in a recession. And what is propping up artificial intelligence right now? Debt. Okay, now, we're going to keep talking about that. But first, I want to talk to you about this bounce that we had today. Because the bounce today, I think, is heavily driven by an unwinding of a massive amount of shorts that we saw go into triple leveraged options and position taking on SQQQs. So the SQQQs are the triple leveraged short for the QQQ index. And volumes or flows into the SQQQs on Thursday were massive, absolutely massive, like $12 billion of volume into this. Those buys had to get unwound today. And there was actually a really bullish signal this morning. Well, there were two really bullish signals this morning that suggested today could be a green day. The first really bullish signal was Jim Cramer going bearish. 9 hours ago, Jim Cramer said there's no reason futures should be higher. This is the curse of the bulls. And then I'm like, all right, that's a bullish catalyst right there.
Bullish catalyst.
This is why I call Jim Cramer Kim Cramer. It's like Karen Cramer. Kim Cramer cast doubt, most bullish catalyst you could ask for. But there was something else. Yes, and this is not a pitch. This is to teach you. In the Alpha report this morning, I said, look, today is a test for the market, okay? The test for the market today is, can we hold 595 and can we get to 607? These are copy and paste lines from the Alpha report. And I want you to see what was in today's Alpha report. Look what I wrote. Thursday, Bitcoin drops before a big dump. Friday, Bitcoin starts lower and the Qs head lower. Today, Bitcoin is $2,000 higher than where it was on Friday. Think about that. It was the first time we actually saw Bitcoin higher. Usually Bitcoin was leading the market lower over the last few weeks. Last 3 weeks, almost certainly. Bitcoin's almost always been lower, 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 lower. And then the Qs go lower. And so I literally wrote, hopefully this is a test, essentially, for positivity for the Qs today. If I had any guess today, Bitcoin starting up 2K versus Friday is a great sign. So fingers crossed the Qs rally and gets to 607. That would be a good sign of strength and reiterates buy the dip. Folks, don't look at the Qs today and look at the numbers. Okay, let's look at the Qs and look at the numbers. You can't make this SH9T up, boys and girls. From 595, literally, from 595, you rocket ship. And look at where we ended today. We ended right here. We had a high of 606.68. Look at that. That's the 607 line right there. Look how close. It's not 100% perfect. That would be like crystal ball. But I have to say, Bitcoin gave us the signal. We pointed out the signal in the Alpha report this morning, and we went line to line today. Now, the question is, will it last? Well, whether or not it lasts has to do with, first of all, we got our short covering. Great. That's great. That could be out of the system now because we were oversold there for a while. But whether or not this lasts all comes down to the capacity for this chart to keep going. Debt, boys and girls. And there's a second issue too, and it has to do with jobs. We'll talk about that in just a moment. But bond issuance, look, we're at the phase where as long as debt issuance continues, AI growth can continue. That's my opinion. As long as we keep getting debt issuance, the AI bubble can keep going. Now, if labor stalls and debt issuance slows, private credit, liquidity crisis, whatever, we are gloriously and royally effed. Now, I want to be clear. We do not want a recession. Recessions are very painful. Many people lose their jobs. They are hell. But things would get cheaper. Stocks would get cheaper. Houses, maybe it depends on where as to whether or not they would get cheaper. Mostly because houses in many parts of the country, not a foregone conclusion that they're going to get cheaper because we have so vastly underbuilt. The New York Times actually had a piece on this morning that we are so underbuilding compared to historical pre-2008 averages. We are still underbuilding today. You know, our poor guy Graham, he made this like podcast here where he laments how horrible it is to build homes in LA. And I watched that and I go, I know. And that is why I love buying real estate in some of these blue states, because they're so retarded with their building policies that all they do is drive housing prices up. So if you want to hedge your investments and diversify into real estate by hedging whatever other investments you make, one of the best investments is literally investing in the stupidity of politicians. What is one of the best ways to invest in the stupidity of super left Democratic real estate policies? Buying in real estate markets that are exposed to those sort of political thinkings. So the more liberal the policies, the more you want to buy real estate there, because they're so incapable of building, they just drive housing prices up, which sucks for people who want to get in. But if you know the game, you just go, whatever. It's crazy. I'm not saying any of that is good. I'm just making an observation. I'm here to make observations about the market. That's my job. Okay. And again, so that's why I say, like, yeah, in a recession, things get cheaper, but not necessarily because housing has been underbuilt And loans are pretty good relative to what you see in what you saw in 2006 and 7. That's pretty bad, 6 and 7. Loans are pretty stable. There's some areas of the market, FHA on the fringes and some of the overbuilt markets that are going to have problems. We know that. But, generally you don't want a recession because you're going to lose your job. And so even if things get cheaper, you're just not going to have the ability to finance new real estate or stocks, which sucks, right? So therefore, the sudden concentration of debt, right? This is pretty sudden. This is a sudden concentration of debt, makes me a little bit nervous. And it either means we have to spend more to keep the Ponzi going, so to speak, which is, to stay ahead of China or whatever, or worse, which, for a World of Warcraft reference is out of mana, and for us means out of money. If companies are out of money, this is a really bad sign. And it doesn't mean the market's going to tank tomorrow, but it means we're like possibly on the last innings, which isn't great. Now, T.S. Lombard had a little piece on the supply session regarding labor, and we're going to touch on this briefly. But something that I do want to touch on briefly as well is this, one of the things that I like about artificial intelligence and artificial intelligence companies is I want to look for companies that have low exposure to these crazy debts. That's why I like what Meta's doing. That's why I've hated Oracle. We went back and looked at our analysis on Oracle, and we saw that the analysis that we did on this channel on Oracle, where I said way too much debt, stay away from Oracle, was on September 10th, my dad's birthday. Do you know what else September 10th was? Can you look at this chart and guess what September 10th was? September 10th, right here, folks, the top of that green line. I analyze Oracle, I go, guys, danger, 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 watch out. This is a bad fundamental play. Because you can analyze stocks in a few different ways. Fundamentals, momentum, right? And then you have to have a strategy associated with that. A good fundamental buy, you could hold for 10 years. A momentum play, you can't hold for 10 years. You swing in and out of that, right? But fundamentally, this was a bad sign, so you just want to stay away from it. Now, 200 divided by 345 means this puppy right here is down 42% since we did an analysis on this channel. Makes sense. Why? Because of debt. And this is why I say stay away from debt. Now, one of the things that we're doing, because we're going to release our AI app this week. It'll be coming soon for December, but we're going to start selling our AI app, which is really exciting, the househack.com or reinvest.co AI. We're calling it the Reinvest AI. And our vision is that we're going to sell 2-year subscriptions and lifetime subscriptions as a founding membership. And the benefit of that is it's twofolded. One, people who sign up, they get in and they lock in a price where we think the product's going to be worth $200 a month, once the product is fully developed in about a year. It's when we think the product will be fully developed. And we'll keep adding updates, obviously. But people who get in now, they get a lifetime subscription at one price, which will be a fraction of, $200 a month, right? It'll be way less than that. You help us build the beta out, but what does that do? It lets us grow without debt. So you as a foundation member, maybe, a few thousand of you join as foundation members, you get the benefit of having lifetime access to a net worth exploding hunter in real estate, our Reinvest AI, right? I mean, it makes you competitive in real estate. We'll talk more about that separately. But what it does is it also injects capital into our company, which then lets us reinvest into the artificial intelligence without debt. So it's win-win. People who join get rewarded with the foundation pricing. In a year, you're going to look back and be like, oh my gosh, it's so much more expensive and it's so much better, a year from now, but I've locked in this lifetime access, right? It's not for sale right now. I'm not trying to pitch it. The reason I'm saying this is because I am putting my money and my company's money where our mouth is. We don't want to finance our AI with debt. So we want to sell a really good service and give people lifetime access and then use that capital, keep growing the product, which is already, I think, very good. Like day one, I think it's already gonna be like, oh, this is kind of cool. You're like literally countrywide throughout the entire United States able to tell us if a deal is, likely to be a deal in the eyes of Kevin or not, nationwide. This is really cool. Now, point of that is staying away from debt because that debt bubble rolls over when jobs roll over. Okay, so we're going to talk about jobs. Let me just quickly disclaim this just so I don't get in trouble with the SEC. If you want to invest in HouseHack or Reinvest.co, it's the same company. Yeah, you still get a 5% yield, but make sure you read the offering circular by going to househack.com or Reinvest.co. This video is not a solicitation. I'm using this as an example. Oh, great. Michael Burry just tweeted. NVIDIA emailed a memo to Wall Street sell-side analysts to push back on my arguments. I stand by my analysis. Obviously, the full analysis does not fit in a tweet. I will release my timeline. The first post, The Heretic's Guide to AI, is up now. It's a very light read. Basically, all right, he's going to double down on the depreciation play. Look, we have already addressed this with Michael Burry. Remember, I said this last week. I said Michael Burry is not right yet. Then the market sold off and people were like, Kevin, it sounds like Michael Burry's right. No. Michael Burry has a depreciation play. That will take a while to play out. What you need for the Michael Burry depreciation play to play out is either the labor market to roll over, the debt cycle to stop, or both. Then the depreciation play will play out. Okay, so Michael Burry is like a future problem. It's not a today problem, it's a future problem. So what else is part of this today problem? Well, the supply session and the Fed. So what do we have over here? Ordinarily, the Fed would be chomping at the bit to cut rates because of the Phillips curve. Right, because our payrolls are trending near zero. The problem is, right now, we're not at zero. In fact, if you look at where we sit right now on payrolls growth, I made this little chart right here. Our 3-month average on Bureau of Labor Statistics provided payrolls is 62,000. Our 6-month average is 59,000 and our year-to-date average is 76,000. So we're not near zero. Once you hit like zero, 6 months later, it tends to get even worse. So once you go to zero for 6 months, it's bad. You're probably going into a recession. But we're not at zero yet. And so I kind of disputed a little bit about this article where they're like, oh no, this is bad. We're trending towards zero. We're not there yet. Now, of course, there are arguments that the stock market will fall, the stock market falling could cause participation to rise as early retirees come back. We already know that, old news. There's also this idea that, because the foreign-born labor supply is declining, native-born is going up. But this is apparently misleading because of the way they collect the data. Like, they collect survey responses, and if they're just getting fewer from one, they assume the other side is higher. It's like totally skewed. Just ignore it. It's a bunch of crap. Doesn't matter. So the point of bringing this up is that right now it's unlikely we're going to see inflation like we saw in the 1967 no landing, because back then we had this massive worker shortage. Okay, so let's phrase this clearly to simplify this. What's bad for inflation is what happened in 1967 and 2021, which is having 2 openings per every 1 worker, okay? Right now, we're the opposite. We have less than 1 opening per every 1 worker. So this means we're not likely to see an inflation problem. They don't mention that in this article, so I'm sort of like leaning on this article to say, look at this chart, here's why it's wrong. We don't have an inflation problem right now. Yes, prices have gone up a lot, but we don't actually have an inflation problem. We have a bigger risk that the Fed is going to make a policy mistake by not cutting rates. That's, I think, why markets are also enthusiastic, because Waller said, hey, we're going to go for the cut. Mary Daly today is like, hey, we're going to go for the cut. So where does that leave us now? We have a lot of information here. We know what's going on with the AI debt bubble, the recession, stock performance and movements. We know to stay away from the debt plays, talked a little bit about real estate, talked a little bit about labor. How do we put all of this puzzle together? Here's how. First, we need to hold 605 on the Qs, okay? That's pretty important. Then, no more private credit pain. Also very important. Any kind of shock here, shock would be very bad right now, okay? So hold 605 in the Qs, no more credit pain, great. After that, we really want strong retail sales, will likely get because people don't stop spending until they lose their jobs. And then we go into the DEES 10 Fed meeting with a 98% chance of a Fed cut. So far, We're climbing over 76% because Mary Daly and Waller are pushing for that rate cut, which is great. This has U-turned the odds of a Fed rate hold, which on Friday morning, if you watch my video Friday morning, I'm like, this is actually good. Like, Waller's coming out trying to talk this up. Remember what we said last week? You need the Fed to talk up the chance of a rate cut. They have until this Friday to do that. So between now and Friday, talk up the rate cut, get us to 98%. That's bullish. Strong retail sales will likely get. That'll be bullish. No more private credit pain. That'll be good. Then, if we can get through the next 2 months with few layoff announcements on top of what we've had, we might be able to get back to employment growth, and we stick a soft landing with major bull catalysts. Like, think about the bull catalysts that we have. Deregulation, that's huge. Then we have the tax incentives from the big, beautiful bill. That's huge. Then on top of that, we're expecting fiscal stimulus and rate cuts, right? Potentially stimulus checks, more rate cuts. This is all good. We're hoping inflation stays tame so we can keep getting rate cuts. We can stick this. So that's why I think there are opportunities to spend some money on those 10-year stocks to buy. And that's why I'm kind of in the middle right now. I'm like, I know we're shock prone. I'm selling where I don't like my exposure, and I'm buying things I'm willing to hold even through a recession for the next 10 years. And I'm trying to stay away from debt-heavy plays, because debt is what's going to take this economy down. As soon as that debt bubble in AI stops, I start getting nervous. And that debt chart, this is right here, this should make you nervous too. Anyway, my take on today. Thanks so much for watching. We'll see you in the next one. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.